Hello traders, you are welcome back to the Forex Geek channel. In this video, we are going to be talking about day trading gold. Now, gold is one of the most popular assets for day traders, and with its high volatility, it can offer some of the best trading opportunities in the market. So in this video, we are going to walk you through an effective gold day trading strategy that helps you catch the best moves during the day. Stick around because we'll cover everything from time frames to entry and exit rules to give you a clear roadmap for trading gold. All right. Now, day trading is the art of entering and exiting trades within the same trading day. The goal is to capitalize on intraday price movements without holding positions overnight. Okay, when it comes to gold, this means reacting to short-term volatility and using technical indicators to predict where the price will go next. Now, XAUUSD or gold offers a range of opportunities throughout the day due to its wide fluctuations in price, especially during key market hours. Choosing the right time frame is crucial when day trading gold, and the best time frames for gold day trading are typically 15-minute chart, 30-minute charts, and 1 hour chart. Now the 15-minute chart is ideal for intraday movements and shorter trade durations. The 30-minute chart helps you catch more substantial moves while avoiding excessive noise. Then the 1 hour chart is great for identifying stronger trends and confirming setups. So using a combination of these time frames can help you spot trends, entry points, and exit levels with more precision. Keep in mind that the shorter the time frame, the more often you'll need to monitor the charts for quick moves. All right. When day trading gold, there are a few indicators that are particularly useful in spotting high probability trades. The first indicator we are going to be looking at are the exponential moving averages. We are going to be using precisely the 9 EMA and the 21 EMA. All right. The 9 EMA and the 21 EMA. Okay. So the 9 and 21 EMAs are great for determining trend direction and identifying entry points. When price crosses above the EMAs, it signals a potential uptrend. Okay, when you have price cross above the EMAs, it signals a potential uptrend. And when it crosses below, it signals a potential downtrend. All right. Like you can see what happened here. You can see that after the crossover, there was actually a buy trend. And here, after the crossover, well, there was actually a consolidation phase at first and a move up before it came down again. Well, this was just a phase of consolidation with a false breakout to the upside, and then now it's seeming like we are having a legit breakout to the downside, but it depends on if this retest plays out as expected, because if this happens to be a legit retest, then we might see price come back downwards. But if price happens to get back into this zone and go back upwards, then it might be a wide consolidation that we are looking at. Okay, so it depends on the reaction of price around here. Now the next indicator we are going to be looking at is the RSI, the relative strength index. You can use the RSI to determine overbought or oversold conditions. An RSI reading above 70 suggests overbought conditions, while below 30 suggests oversold conditions. So this can help you predict reversals or pullbacks. Okay. Now, to execute the gold day trading strategy effectively, you will need clear entry and exit rules. All right, here's how to set them up. For your entry rules, you need to wait for the price to either break above or below key support or resistance level. So you need to map out your zones, your key support and resistance zones on the chart. You need to map them out so that when price comes in contact with those zones, you will be watching out for the reaction of price around those zones. Okay. For example, we can see this zone, at this particular zone, you can see there was a rejection here, but when price got there again, it got rejected. All right. And now we actually have a zone around here, right? We even have one around here. Price has already climbed above this, so it might be heading towards this now. If it gets rejected around this, then it depends on if a breakout happens again or if a rejection happens that sends it back down. If we have a breakout to the upside, we might see price retest this or even this, right? But if there is a rejection, then price might come down back to the 30.65 zone. All right. So for our entry rules, you need to wait for price to break above or below key support or resistance levels. Then you look for a confirmation from your indicators. For example, an EMA crossover in the direction of the breakout combined with an RSI reading that is not in the overbought or oversold zone. If you have a breakout to the upside and the 9 EMA crosses above the 21 EMA, and at the same time you have the RSI above the oversold territory trending upwards, that is a confirmation for a buy. Okay, and ensure that the volume is supporting the move. Okay, watch for volume spikes when price breaks a key level. Then when it comes to exit, you can exit the trade when the price hits a predetermined target based on nearby support or resistance levels, or you can use risk to reward ratios. For example, if you enter a buy, maybe after this bullish move has been confirmed, if we have a legit breakout around here, you can target maybe you can target the next key resistance zone for your take profit, but just ensure that you have a good risk to reward ratio. Okay, let's say you are entering on the 15-minute time frame. Yeah, let's say you're entering on the 15-minute time frame, and then your breakout has been confirmed here. You can see the RSI upwards. You can see that the bullish crossover is already gradually happening. So let's just say you entered somewhere around here. Let's just ensure you have a good risk to reward ratio. Basically, you can set your stop loss below the previous swing low, and then your take profit can be at key resistance zones. Okay, in this case, our risk to reward ratio is not good enough. This is 1:1. Had it been we have something like 1:2 or 1:3, minimum of 1:2 basically, then in that case you can go ahead to enter your trade, because the minimum risk to reward ratio that is recommended is 1:2. Okay, ensure that your potential profit is ×2 of your risk. Or you can also consider using a trailing stop, to lock in profits if the price continues moving in your favor, or you can exit quickly if the price starts moving against you, right? If you notice that maybe you are in profit and suddenly the price starts gaining momentum against you, you can just exit your trade quickly. All right. Good risk management is key to day trading gold successfully. Here are some best practices. Limit your risk to 1 to 2% per trade. Never risk more than this amount of your account on a single trade to ensure that one loss does not impact your overall balance too much. And also set stop losses. Always use a stop loss to protect yourself from large moves against your position. All right. And make sure that you keep a favorable risk to reward ratio. Aim for a risk to reward ratio of at least 1:2, meaning you are willing to risk $10 to make $20 on each trade. All right. Day trading gold can be highly rewarding if done correctly, but controlling your risk is just as important as identifying trade setups. All right, this gold day trading strategy is designed to help you catch the best gold moves during the day while managing risk effectively. By following the time frames, indicators, and exits, entry and exit rules we discussed, you can start applying this strategy right away. If you found this video helpful, don't forget to like and subscribe for more trading in strategies and insights. Have any questions or want to see more on gold day trading? Drop a comment below and let me know. Happy trading, and I'll see you in the next video.